Welcome to the FEDLIFE Podcast with Dan Sipe from Serving Those Who Serve. In this podcast, Dan draws from years of financial experience to help federal employees overcome challenges that every Fed can relate to. Join us for this journey as we reach, teach, and serve to help you make the right financial decisions. Now, on to the show.
Hello and welcome to this episode of the FEDLIFE Podcast. I am your host, Dan Sipe. Additionally, I am the branch manager here at Serving Those Who Serve, Sipe and Associates. I will begin, as I always do, by saying thank you. Thank you for taking the time to listen. Thank you for your service. You don't hear it enough. You're always going to hear it here. Whether it's a podcast, whether it's a webinar, you can count on it. Ed Zurndorfer, he's here again. Always have the guru with us as part of our ongoing mission to reach, teach, and serve you. Those of you regular listeners, here it comes. At the outset, I need to say the opinions of our guest, Ed Zurndorfer, no matter how awesome they are not the opinions of Raymond James of Serving Those Who Serve. This podcast is presented for information only and is not intended to be taken as advice. All listeners should consult their personal advisors before taking any action. And if you don't have a personal advisor, hit us up at Serving Those Who Serve. We will help you any way we can. Once again, we're following Ed's FedZone articles. But wait, there's another way to keep learning from Ed from the privacy of your home, and that's to sign up for the weekly serving. Every week, we'll deliver the best of Ed, Jen Meyer, Benefits Ben, right to your inbox. So don't miss out. See our subscription information on this YouTube page for the podcast. Well, I know podcast rules dictate that we do not mention years, months, or days, but Ed and I are here to help feds now. So we are flouting the rules, and we are covering Ed's article on year-end 2022 tax planning suggestions. Now, I'll tell you up front, some of these are probably going to be evergreen. So if you get around to this, later on, don't freak out. It's probably going to be good advice for next year too. But let's dig into this. So Ed, you have some ideas for folks to save some money on taxes. First up, you talk about using capital losses to offset capital gains and ordinary income. Lots of cool terms there. Tell us about it.
Yes, Dan. Let's face it, Dan, this has not been a great year for the stock market.
Nope.
And I know a lot of my tax clients are not very happy. They said, look how much money I've lost this year. And I said, listen, you really haven't lost any money. It's all on paper. Okay. At this point, I mean, you will lose money if you sell your investments at the wrong time. And that's not necessarily the best thing to do.
Sure.
And I want to say just something up front here that while I'm talking about using the capital losses from selling investments outside one's retirement account as a strategy, please, before anyone employs any of these strategies, please talk to your financial advisor to make sure that what you're going to do in terms of selling your investment fits within your overall financial goals and plans. Mm-hmm. What I'm really saying here, Dan, is please do not let the tax tail wag the investment dog. Yeah.
Perfect.
Perfect
analogy.
There is some benefit to selling capital assets like stocks, bonds, mutual funds, open-ended mutual funds, closed-end funds, ETFs. Yes, there are some advantages when you sell those at a loss, and we're going to talk about that now. But that should not really, when you do this, selling your investments, it should not result in a total wipeout of your plans and goals for the future. All right, so let's talk about what can be done to help, say, mitigate some of these losses. I want to say up front, again, what we're talking about is selling capital assets that are used investments in capital assets, investments such as stocks, bonds, mutual funds, ETFs. We're talking about individual stocks, mutual funds, bonds, individual bonds, mutual funds, etc. Okay. That are held outside one's retirement account. We're not talking about selling things within an IRA or within the TSP, strictly non-retirement accounts, non-retirement brokerage accounts. Mm-hmm. So if one has some investments and these investments, like for example, let's take individual stocks. They have gone down in value. When I say they've gone down in value, what you paid for these stocks, and that includes reinvested dividends and capital and any capital gains within the stock or stock mutual fund, the total value of your investment has gone down compared to what you paid for that, including reinvestment. Then if you were to sell that, what you have right now is called a realized loss.
Yep.
If you were to sell that investment, resulting in a loss, that is what's called a recognized loss, recognized capital loss. And that capital loss can be applied dollar for dollar against any capital gains you may have incurred during this current year, resulting in tax savings. How does it result in tax savings? Because if you were not to have any losses to apply against those gains, you would have to pay tax on the capital gain, on the net capital gain, by offsetting the gain dollar for dollar. And if you offset all of the gains, you would not have to pay any taxes at all. Okay. Now, if you end up with more capital losses than capital gains, then up to $3,000 a year can be applied against other income, such as salary income or pension income or interest income, rental income, dollar for dollar. So that could result in some more tax savings.
Yep, absolutely. And, folks, here's the thing. I'm never saying to people, don't be a do-it-yourselfer. What I am saying is if you're going to be a do-it-yourselfer, make sure that you are an incredibly educated and informed do-it-yourselfer, because nobody likes it when the market is down. But there are times when you can strategically take losses. This is not giving advice, so my compliance department won't get upset. The strategy is called tax loss harvesting, and it's a way to get some advantage from a circumstance that might not be that great. What we believe within our philosophy is no matter what's taking place, there's probably a better way within each one of those. So for example, this is going off script a little bit, but you may have noticed there was a lot of coverage over the last couple of weeks about the I bond with Treasury Direct, that for a stretch you could get in and it was 9.62% interest. Well, that came about as a result of higher inflation. Okay, so higher inflation is not great, but finding an opportunity like that is not a bad thing to find. The market being down, not great, but being able to take advantage of a tax loss harvest that helps you against capital gains now and in the future, helps you on your income now and in the future, because generally the losses don't expire. Is that correct, Ed?
They carry over from one year to the next. Although I got to mention that if someone is single and they have losses carried over from one year to the next, if they pass away, any losses at the time of their death cannot be inherited by someone else.
Gotcha.
Or for that matter, their estate cannot use those losses in any type of estate. If the estate is, let's say, making some investments.
Gotcha.
And finally, for spouses who file married filing jointly, yes, the loss can be carried over from the losses can be carried over also from one year to the next. And if one spouse were to die, then the surviving spouse can use those losses, but only if they held the account as married joint tenants with rights of survivorship. If
Gotcha.
They had the account in their name only, the one spouse who died, then the surviving spouse cannot use any of the leftover losses. It's a very technical point, and I advise individuals who might be in this position, please talk to a professional tax advisor. Okay,
100%.
Before you do anything. And I
Got
repeat, a tax advisor. Don't talk to your stockbroker, financial planner because that individual has no business, is not allowed to give out any type of tax advice.
I agree. I've got 35 years of saying it is important that I tell you I am not a CPA and I cannot give tax advice. So that is an important distinction. All right. So actually kind of a nice segue there, because you sort of touched on the filing status of the person. So that's also your next point that a lot of people may just take for granted, which is, their filing status. And what's your insight on that?
In my years of experience doing taxes, we're going back almost 40 years now, Dan. My experience is this: those individuals who are married, that filing what's called married filing separately is not the most advantageous way of filing your taxes.
Sure.
There are some situations, though, in which it does make sense. For example, if one spouse earns substantially less than the other spouse, or when one spouse may be subject to IRS penalties for issues related to tax reporting, it may be advantageous for the couple to file as married, filing separately. Again, you should let a professional tax advisor make that decision. You shouldn't make that on your own.
Sure.
And because there are, like I say, there are some situations, some unique situations in which filing as married, filing separately does make sense. Does make one sense. It does make sense. Most cases, in my experience, married filing jointly is the best way to go. And if we're talking about filing 2022 taxes, if you have any questions in your situation, whether married filing separately would make sense, please, before the end of December, you and your spouse meet with a qualified tax advisor to discuss this issue. Put all your information on the table and let the tax advisor make a recommendation. Do not do this on your own. And again, I'm saying before the end of December, because maybe there's some things you could do now that perhaps would make it better for you to file married filing jointly. Some things you could just making some moves now that could result in in filing in the most advantageous way. Now is the time of year we got to do this, Dan.
Sure. Now, number 3, this is always close to my heart when we get to these topics, is deciding when to make charitable contributions, whether 2022 or 2023. Walk us through that one.
Okay, Dan. This issue of what year to make, it was the best year to make charitable contributions, really has gotten a shot in the arm as a result of the 2017 tax law change. It was called the Tax Cuts and Jobs Act of 2017. And among the things in that tax law, number one, is the fact that it made the standard deduction more attractive. What I mean by that is when you file your taxes, you have a choice. Should I itemize or should I take the standard deduction? When I say itemize, it means that you're going to list you're going to include the items that you can include as deductible. For example, your medical expenses exceed the amount of your medical, dental, vision expenses that exceeds 7.5% of your adjusted gross income. Mm-hmm. Your state and local taxes, property taxes, not to exceed $10,000. Mm-hmm. Your mortgage interest, although there's a limitation on that, which we're going to talk about here in a few moments, and charitable contributions. Charitable contributions include cash check donations you make, goods that you donate, to the Goodwill or to all the organizations that call you to pick up, used furniture or clothes or things like that. Also making donations of your stocks and bonds that you feel that you no longer need, you get a deduction for donating to the charity. All right. So when you add up all these eligible itemized deductions that you include as itemized deductions, if it exceeds what your standard deduction is, then you're better off what's called itemizing. On the other hand, if you don't have a lot of itemized deductions to the point that it does not exceed your standard deduction, then you're better off taking a standard deduction.
Gotcha.
The 2017 law made itemizing less attractive in the sense that the standard deduction was doubled for all filing categories: single, married filing jointly, head of household, married filing separately. You got a doubling of your standard deduction. So most people, in fact, now do in fact take the standard deduction. Also, as part of it was a 2020 law that said that even if you take the standard deduction, you can deduct, in terms of charitable contributions, $300. That was what it was in 2020, or $600 if you're married. That's per person, per filing category, or $600 in 2021 if you file as married filing jointly. And this is in addition to taking, you got this deduction for charitable contributions, even if you didn't itemize. Now, here's the problem. You got to make a decision when you file your taxes, which is better for you, taking the standard deduction or itemizing. At this time of year, it's a good idea to sit down. Now, how much do I have in itemized deductions? How much do I have in itemized deductions? An idea of your medical expenses, your property taxes. That's very easy because you're limited to a total of $10,000. That includes your state and local taxes that have been withheld from your paycheck or your pension, your property tax bills. I have to say, most people in this country do end up getting very close to that $10,000 limit. Mortgage interest and charitable contributions. Let's suppose someone bought a house in October. Until now, they've been renting. And now they're going to start paying mortgage interest. Chances are they're not going to have a lot of mortgage interest for the rest of 2022, because they only have one or two mortgage payments. And they're thinking about making some charitable contributions. They should consider when they add up all the mortgages they're paying plus the $10,000 in property taxes, whether it's a good idea to make those charitable contributions in 2022 or hold them off to 2023, because in 2023, they definitely should have enough in itemized deductions with a full year's worth of mortgage interest.
Sure.
To make it worthwhile to itemize. So you got to run the numbers here, Dan, to see if it's worth whether it's worth bunching your charitable contributions into 2022 or holding them off, making those contributions in 2023 to make it worthwhile tax wise. I'm not going to get into the issue of whether you should make charitable contributions or not. Of course, you should make charitable contributions. You should always give to charity, and tax reasons should not be the primary reason. It's because you want to give. I had to go off a little soap opera. No,
that's fine. You know where I come down on that, brother. I'm right there with you. No, that makes a great point. So up next, it's one with which we have a lot of familiarity, most of us, and that is the mortgage interest deduction. So what are your thoughts there?
Well, mortgage interest has gotten to be a little bit more challenging because a couple of years ago, Congress was noticing there were some abuses in the mortgage interest deduction. So now IRS has come up with the rule. It's called the mortgage tracing rules to know when you took out a mortgage, what did you actually use the mortgage for? And when did you get your mortgage? I'm saying that because back in 2017, when they passed this Tax Cuts and Jobs Act of 2017, until that law was passed, you were allowed to deduct up to the mortgage interest up on that was applied to mortgages that were less than $1 million. You took out a mortgage of less than $1 million and you used that mortgage to, for your primary, to purchase your primary residence. Then all the interest paid up to that $1 million of mortgage principal would be deductible as an itemized deduction.
Gotcha.
Then, with the 2017 law, it went down to $750,000, $750,000 limit. Okay, that's for all individuals except married. Those individuals filing as married, filing separately, they were limited to half of that, 300 each spouse to $375,000.
Mm-hmm.
Here's the problem. Suppose you sold your home after 2017. You sold your home in 2022. And before you bought that home before December 14, 2017. So you're restricted to the $1 million limit as far as the amount of interest and how much you could, the interest was deductible.
Sure.
Now it's after 2017 and you've sold your home and you bought another home, and maybe you acquired a mortgage that was over $1 million.
Yep.
But you're restricted to $750,000 now. So now when you do your taxes, or when your accountant does your taxes, they're going to have to prorate the amount of your mortgage interest according to how much of it was, as far as the limit of $750,000. Let's do an example here to make it easier to understand, Dan. And it's in that column I wrote, and I suggest individuals read that column. It's coming out this
100%.
week.
Yep.
Frank and Julia, they're a married couple. They file their income taxes as married, filing jointly. They purchased a principal residence in May 2017. The purchase price was $850,000. They made a $50,000 down payment and applied for and were approved for an $800,000 mortgage. Now, because the amount of the mortgage is less than $1 million, the mortgage interest that Frank and Julie pay is fully deductible as an itemized deduction on their federal income taxes. Okay. Then example 3, we have Charles and Hannah. They're a married couple who filed their income taxes as married filing jointly. They purchased a personal residence in May 2021.
Mm-hmm.
The purchase price was $1,100,000, and Charles and Hannah made a $100,000 down payment. They applied for and were approved for a 3.5%, $1 million, 30-year mortgage. During 2021, Charles and Hannah paid a total of $30,000 of mortgage interest. Because they purchased their principal residence after December 14, 2017, the amount of the mortgage interest that is deductible is limited to the first $750,000 of the mortgage principal. Charles and Hannah therefore figure that the mortgage interest that is deductible during 2021, if they couldn't do it, their accountant should know this, is done as follows. We take $30,000 of mortgage interest times the following ratio: $750,000 divided by $1 million equals $22,500. In other words, that $30,000 being prorated according to the $750,000, $1 million limits. A little complicated, huh, Dan?
Yes, little bit. And so our next item in your article is kind of the cousin of the home mortgage interest deduction, and that deals with home equity interest from the home equity loan. Either whether it's a home equity loan or a home equity line of credit. Now, we need to follow some rules here, correct?
Oh, yes. And this goes back to what's called the mortgage tracing rules. Let me just go to the general rule. Interest on home equity debt may be deductible if the individual or couple who took out the home equity loan was used the loan proceeds. They're approved for the loan, and they used the loan proceeds to buy, build, or substantially improve their home. For example, interest on a home equity loan used to finance the building of an addition to the home. An example in which the interest paid on a home equity loan is not deductible is when the home equity loan proceeds are used to pay off credit card debt.
Gotcha.
Or maybe to purchase a car. If you could use money from a home equity loan to purchase a car, the interest you pay on that home equity loan is not going to be deductible. Once again,
Gotcha.
if you just took out one loan and you're using it for various purposes, building to make an addition to your home, that portion, the interest paid on that portion of the loan would be deductible. Then you use some of the loan to pay off credit cards. Then you can't deduct that interest.
Sure.
Dan, in my tax practice, every year I sent out my tax organizer. And one of the questions I had, did you refinance? Did you take out a mortgage? Did you take out a home equity loan? And I got to ask questions. What did you use the loan for? What were the proceeds? What were the proceeds used? And my client said, what are you asking me those questions for? That's really none of your business. I said, well, you hired me to do your taxes. It is my business. Because if I knew that you're not using that loan for things that you can use it for to deduct the interest, I'm not going to allow the interest deduction.
Exactly.
It's gotten very complicated, Dan. It's called the IRS's mortgage tracing rules or home equity loan tracing rules.
No, that it's important to know this stuff. Our last two are gain and loss on a principal residence and loss of the deduction of mortgage insurance premiums. So tell us about these, Ed.
Yes, as you know, Dan, a lot of over the last couple of years, not so much now because the interest rates are going up. It's been a terrific market for selling your house. Whatever reasons, low interest rates. I know I have several clients who just retired and they want to downsize their homes. They had these huge homes that they raised families in. Maybe they just don't want to own anymore. They're tired of all the upkeep in the house. They decided to sell. And when they sold their houses, they were not going to buy another house, maybe, or they wanted to rent, or maybe they wanted to downsize, get a smaller house. So when they came to me to get their taxes prepared, they were said, well, we sold our house. We're prepared to pay the taxes. We made a huge profit. I said, not so quick, because under law that's been in effect for exactly 25 years now, when you sell your principal residence, this is a place that you've lived in for at least 2 out of the last 5 years, ending on the day you sold your house. Again, it does not have to be 2 consecutive years, but it has to be 24 months within the 60-month period ending in the month that you sold your house. If you're single, you get to exclude, I repeat, exclude, no taxes due on the first $250,000 of profit. If you file as married filing jointly, and both of you have been living in this home, this principal residence, we're not talking about a rental property. We're not talking about a second home, a vacation home. We're talking about a principal residence. Then you get to exclude the first $500,000 of capital gain with no requirement to buy a more expensive principal residence. A lot of my clients think, well, that isn't that the law? You got to buy something more expensive to avoid the capital gain. Well, you're about 25 years too late, because that was the old law that no longer applied as of May 5th, 1997. Gotcha. You walk away tax free. Now, if you end up buying something that's more expensive, and then you sell that home, you can use the exclusion again. But I will tell you, it's only the first $250,000 if you file single, $500,000 file married jointly. Only the first $250,000, $500,000 is free from capital gains taxes. Anything above those amounts in terms of profit will be taxable, even if you buy something that's more expensive.
Sure.
If you sell your house, a principal resident, at a loss, it's non-deductible. It's non-deductible. Okay. You cannot deduct a loss on the sale of a principal residence on your income taxes. No capital loss there.
That stinks.
Well, I got to tell you, I feel maybe Congress felt you got all these benefits, while you own the home, like mortgage interest deduction and so on, and you reduce your taxes. We let you deduct your, and then you made improvements to your house, and that in itself resulted in you're paying less capital gain tax because you can add it to your cost basis. Come on, it's payback time. You got to pay
No,
them.
I get it, Ed. I get it. But see, it's the empath in me. I'm sitting here thinking, if somebody's selling their house at a loss, it might not be a good time for them. So, I'm always putting myself in that person's shoes. So I get your point. So let's talk about that loss of deduction for mortgage insurance premiums.
Yes, there's no longer a deduction for mortgage interest. Mortgage interest. What is that? If someone buys a home and they end up paying less than 20%, make less than a 20% down payment, then the mortgage company is going to require them to purchase what's called mortgage insurance to protect the mortgage company's interest. That
Sure.
mortgage insurance until this year was deductible as a deduction. This year it is not. It is not. It stopped as of December 31st, 2021. So
Gotcha.
Our listeners, or if they know anybody who's currently paying mortgage insurance, they will not be able to use that as deduction on their 2022 taxes.
Gotcha. Okay, Ed, I think that kind of rounds out the article, folks. I want to loop back to our first point, when we talked about, losses on investments outside of retirement accounts. If you're hearing this the first time and these are new terminologies and you have an advisor, ask them about tax loss harvesting and things like that. It's important to understand that you are going to have so many different financial seasons in your life, and there's something good about every season. I'm a four seasons guy, Ed. I don't tell a lot of people that, but I love visiting warm places. I even love visiting some cold places. I wouldn't want to live in a place that was that way all year round. So that's one of the reasons I like where we are, because we get four seasons, and there are some things that I really love about each one. Well, that is the way I've learned it goes with financial seasons too. And if you have good strategies, if you are well informed, then there are places where you can find advantages in lousy situations. That's also why I kind of spoke up on the poor person who has to sell their house at a loss. But
And
again,
go ahead, Dan.
No, again, I get it, but go ahead.
I just want to mention one thing we did not bring up, and I think it's worth mentioning in terms of selling your investments. Please, when you're working with a financial advisor, beware of what's called the wash sale rule.
Oh, yeah.
If you sell your investments, the stocks, bonds at a loss, and then you say, "Wow, I just sold at a loss. Now I got one benefit." But there's another benefit when you buy something and it's on sale, because you just sold something and it went down in value. Yeah, you're upset about that. And then I'll get my benefit now by selling it. I'll get at least to get some of that loss back in terms of reduced taxes. But there's another benefit, because the best time to buy something is when it's on sale.
100%.
It has a reduced price. We do that with our everyday commodities.
Yep.
I tell clients that there is a good side to the market being down, because now you have an opportunity to buy something, an investment that is reduced in price. You do that when it comes to buying shoes and clothes and and food. You're running for sales. Well, that's the upside, in my opinion, on a down market. But you got to be careful, because the IRS has a rule, says that if you sell an investment, a capital investment, at a loss, a stock, bond, mutual fund, ETF, and you buy back the identical investment within 30 days before or 30 days after the day that you sold that investment, the IRS is going to disallow the loss. It's called a wash sale.
Yep.
Please make sure that this is brought up in your discussion with your financial advisor. Just say the word wash sale.
Oh, yeah.
Just to remind your financial advisor.
Nope, 100%. Ed, once again, I don't know how you do it, but I'm glad you do it with us. And as I always say to you, thank you for what you do for the feds, and thank you for what you do with and for our team to help us get better and better.
My pleasure,
well,
Dan.
folks,
It's always a pleasure.
Yep. Well, folks, that's a wrap. We are, say it with me, serving those who serve. Be sure to subscribe to this podcast on a YouTube channel or Spotify. Remember to share it with friends and strangers. Check us out on Twitter and LinkedIn. Do not miss our live webinars every week. Just go to swserve.com. You will see the webinar button. Click it. It'll take you to the landing page. The guru will come to you, reach you where you are, teach you where you are, and above all, serve you where you are. Sign up for one, sign up for all. Share that page with your friends. I promise you they will thank you. Sharing the page, by the way, is a great holiday gift. I'm joking. Do not wrap that up and hand it to somebody, although it would be cool. And if you do, send us a picture. Be sure to read it every week in the Fed Zone at fed-zone.com. And don't forget to sign up for the weekly serving. Ed and all the Fed stars from SW Serve coming right to your inbox every week. So in closing, for Ed, the crew at Serving the Serve, and me, Dan Sipe, good luck, Godspeed, and above all, remember, it's your Fed life. Make it a great one because you deserve it. Stay well, everybody. We are out.
Thank you for listening to the FEDLIFE Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Serving Those Who Serve or Raymond James. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Securities offered through Raymond James Financial Services Incorporated, member FINRA SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services.
Raymond James is not affiliated and does not endorse the opinions or services of any of the quoted professionals or their respective firms. Any opinions are those of Dan Sipe and not necessarily those of RJFS or Raymond James. This case study is for illustrative purposes only. Individual cases will vary. Raymond James is not affiliated with and does not endorse the opinions or services of the quoted professionals or their respective organizations.
Neither Raymond James Financial Services nor any Raymond James financial advisor renders advice on tax issues. These matters should be discussed with the appropriate professional. Investing involves risk, and you may incur a profit or loss regardless of strategy selected, including diversification and asset allocation.